Thank you for joining us for another episode of the Finance Magnets Blockchain Podcast. Today's guest is joining us from San Francisco. Good morning, Rosario.
Hi, good morning, Avi.
Rosario will be on our blockchain and FX panel next week in the Finance Magnet London Summit. And this is our opportunity to hear, a bit more about his opinions on the subject. So, Rosario, if you can start by telling our audience about your company, and what do you offer?
Yeah, absolutely. So we founded OTCXN Network, which we call OTCXN, about 2 years ago after I exited my last company, FX1, to an investment bank in New York. And the fundamental thing that we're trying to solve for is really the credit gap that exists in the FX space today. So we have a technology solution that makes it possible for anybody to trade really anything, starting obviously with FX, with anybody else without having to have prime brokerage credit involved as a requirement. So of course we support an asymmetric relationship, so we can have clients who are prime broked trading with clients who are not prime broked, and we very much want that kind of participation from the prime brokers, and we have a whole suite of tools that we provide to them that helps minimize their risk and give them more control, and hopefully helps them increase their overall profit margins by some of the tools that we provide without charge. That maybe will help them lessen their dependency on some of the other existing solutions that they're using today. But the real thing that we've created is this peer-to-peer trading network, and I guess the key thing that blockchain brings to the table is it lets us do this with pure technology in a way where we are not a trusted intermediary. So we don't have to hold clients' collateral. We don't have to be party to or a signatory to any of the funds or collateral. We actually have a technology solution that we give to custodial banks that lets them tokenize or digitize the cash that a client has in an account with them. And those tokens are then issued onto a blockchain. And I'll talk more about our blockchain and how it differs and why it's very important. Once that collateral is issued onto the blockchain in the form of those tokens, and two parties do that, they can then see each other and essentially trade with each other, backed by that collateral. And of course, to do this is not a small undertaking. You have to really deliver the entire trade to settlement lifecycle. So we've had to obviously build out this entire blockchain-based infrastructure, all of this real-time collateral management layer, and then obviously all of the trading apps that sit on top of that, from pre-trade credit, through margining and auto liquidation to post-trade messaging. So really, it's the complete end-to-end stack that makes that possible. It's a completely new hybrid market model that makes it so that somebody who can have basically people can access counterparties they've not been able to access because of credit restrictions.
Mm-hmm. And can you speak about one of the major issues in FX, if we're staying in that domain, is prime brokerage and the problems with liquidity if you don't have a prime brokerage. So how does this network circumvent the issue?
Yeah, well, the real problem is the requirements, post S&B and with general de-risking by the banks and possibly other reasons. There's been a tremendous shrinkage of the available or the allocation of credit lines to firms to trade FX. The requirements are, we all used to know firms that had maybe a $3 million balance sheet that used to have a tier 1 prime broker. Nowadays, they want to see a minimum of 25 or 30, some of them as high as $100 million balance sheet. We've all heard the stories about it taking 12 to 18 months or longer to get through the entire credit underwriting process. I mean, it is a full-blown, credit underwriting process you're going through with a major bank. So it necessarily is quite involved. And basically, if you look at the numbers, like the Bank for International Settlements, this last reporting period, there's actually been a decline of spot FX only volume, forgetting all the other flavors of FX, of about $300 billion a day. So it's the first decline in 15 years. And we attribute a lot of that to this actual credit gap, the fact that so many players have essentially been priced out of the market. If you think about a lot of the higher frequency trading strategies going from $3 or $4 a million with tier 1 prime brokerage and getting pushed downstream to a tier 2 credit intermediary where you're paying maybe $10 a million in known costs and God knows what in unknown costs based on the various things that happen when you have other people intermediating your liquidity. This is that's a whole segment of the proprietary trading landscape that effectively got priced out of the market. And we've known high frequency prop trading firms that had very, very small balance sheets that were doing many yards a day of business. So all of that in the aggregate, is part of why we see this decline in the BIS numbers. And we really think that this is just purely an access problem, and that if we bring wholesale access back to the market where people don't have to qualify for tier 1 prime brokerage, but yet they can face other counterparties without counterparty or settlement risk, which is the part that we solve technologically, that this will greatly increase people's access to liquidity. And you'll no longer be beholden to one of the downstream providers that basically dictates not only what liquidity providers you can have access to, but what technology you're going to take that liquidity through. So this is really what we're doing is changing how people face each other from a financial point of view, so that counterparty and settlement risk is gone. But the trading still happens in the same way. So the beautiful thing about this is there's no technology integration or adoption. It's still fix in, fix out, whether that's a bilateral fix connection or a multilateral fix connect, multilateral trading via fix over an existing third-party matching engine like Fastmatch or something like that. And we're talking with all of those usual suspects about setting up private rooms just for members of our network so that they can trade on a many-to-many basis there.
Mm-hmm. So, without getting too technical and requiring, too much of our listeners, can you describe, the process of a transaction, like, from start to finish? How does it happen? It starts with tokenizations, correct? From what
That's
you
correct.
said. Mm-hmm.
Correct.
So can you? Mm-hmm.
Yeah, I'll walk you through it. So basically, two counterparties, if you can imagine, they have an account at one of the custodians that is a member of our network. So we're in the process of onboarding various custodians that are willing to use our software stack to do that tokenization and perform that service. It's a positive thing for the custodians because it's potentially a new chargeable line of business in a very sort of fee constrained world. So a lot of the custodians that we're talking to are quite interested about running the service. We give them the software for free, so they do that tokenization, and actually, without getting too technical, there's multiple blockchains actually in our system. So this is a multi-dimensional sort of blockchain of blockchains where we have an inter-blockchain communication protocol that sort of creates a global virtual ledger of all of these independent ledgers. So when a custodian issues USD-backed tokens onto the blockchain, it actually spawns that USD ledger that is owned and operated by that custodian. And now when that party, imagine that same custodian then issues Euro-backed tokens for another client, that spawns that Euro ledger, and that initial allocation is recorded there. So those two parties now could trade anything with each other. They could trade any spot FX pair. Doesn't have to be, it's not tied to what they actually have underlying as collateral, because we do all the magic that sort of normalizes all of that. So that collateral is effectively just guaranteeing their trading activity. And we do all of the enforcement of that programmatically. So now when they trade, imagine that first party that has the dollar tokens trades with the counterparty that has the euro tokens, and let's say that the euro tokens counterparty loses money to the other fellow. That basically means that on that euro ledger that the custodian operates with the software that we've provided, there's a reassignment of that portion of that realized P&L, that portion of the tokens that are actually on that ledger. So now the other counterparty owns tokens that have euros behind them, issued by that custodian, and they can at any time sweep that back into their home currency and into their bank account by putting that request in through the tool set that we give to each trading entity. So it really just, the magic of doing all the real-time collateral management, doing all of the conversion of everything to normalize everything to dollars in terms of from a collateral point of view, all of that is happening. The settlement, what's interesting about it is that we obviously are doing the clearing, but the settlement is happening in real time as that P&L is realized, because at that moment in time, the P&L, that portion of those tokens is being ownership is being reassigned in real time. So you have a measurement of settlement finality in real time as you realize P&L with other counterparties on the network, which is an important aspect of the system. And so your only exposure is actually to the custodian, which is no different than the deposit liability you would normally have with that custodian if you had a checking account at that bank. So it minimizes the risk a great deal, and you can still trade with leverage, and we have ways of managing and handling all of that. But this is not, a fully funded sort of trading scenario. And then in terms of how the trades actually occur, and the reason why it's so safe and why we can say that this entire process is provable from front to back, is because we do this, what's called an atomic swap or an atomic exchange that happens in real time on ledger, where there is basically a guarantee of underlying collateral to back that transaction. And so if one side failed, there would be no consummation of the transaction. And that has a really profound impact, because that trickles down to things like being able to give tools to prime brokers where they can see real-time trade matches with cryptographic guarantees, meaning that there's no such thing as a DK under this architecture. There can be a DK only from a technical failure. There can't be a DK related to a counterparty backing out of a transaction, or there not being sufficient collateral to support a transaction.
Mm-hmm. Okay, so let me ask you a more broad question, right, about the technology in general. Because we'll be speaking about in the panel about how blockchain is affecting the FX world. So let's say 5 years from now, how do you see the FX trading changes due to blockchain technology?
Yeah, it's a good question, and it is quite broad. I mean, I think it depends on, the details of the answer depend on which constituencies you're talking about, right? So obviously, if you look at even CLS has some big blockchain initiative they're doing right now around making transaction processing more efficient. There are plenty of vendors now doing things. If you look at Cobalt DL and others that are doing very, very specific point solutions using blockchain to solve particular pieces of what is really a series of issues or inefficiencies that could be resolved using blockchain. So some of these firms are tackling these very discrete parts of that, and most of it seems to be oriented towards the post-trade and processing, right? And I think the reality is 5 years from now, I think probably most of the post-trade processing of transactions is going to be on some form of blockchain-inspired solution. I think that's a clear path. I mean, if you see CLS jumping in and doing that, there's a reason for that. We're seeing that across all asset classes, so this is not unique to the FX space. I think where it gets really interesting to me is just there could be a complete shifting of the way that or the role of different actors in the ecosystem. So I can see a time where banks that have backed away from prime brokerage, because they don't want to provide, credit, or because of the overheads and the risks and the low margins and all of the issues around that. So maybe some of the smaller players could potentially support clients on our network and make a prime broker-like fee for playing some part of the role where some of the risk is mitigated and handled by a system like ours. I think the most impactful things are not the cost savings that occur from the efficiencies of processing transactions in the back office. I think where it gets really exciting is when you realize that blockchain is this trust machine, and you can do things like for example, use our tokenization solution. If you're a broker that's trying to grow your business and you're in a jurisdiction that makes that challenging because people have to wire you their funds, and maybe there are rules, that don't mandate segregated accounts and things of this nature in that jurisdiction. There are ways to set this up through that custodial arrangement whereby the funds are held there. You still provide all your value-added services to your clients, and therefore make your fees. But we can solve two things for a firm like that. Make it so that they don't have to be a trusted holder of client collateral, and then on the other side of that, give them direct access to the wholesale market without a prime-to-prime in the middle, right? So these will create some major shifts in how the overall ecosystem works. And I think these kinds of initiatives, although they're very ambitious and quite large in scope, I think they're perfectly feasible, and I think they'll have profound influence over the market, in general. And I think that makes it really exciting. It's that sort of, using it for what it's intended to be used for, where you have, this, what we've done basically for the first time ever, you have a provable end-to-end trading system where every aspect of everything that happened, from the price that an order was triggered with, to the actual trade match, all of these things are provable, including things like changes of, credit limits and things like that. These are all things that actors in the system are now signing digitally and have responsibility for. There's undeniability of these transactions, and that's a really, if you look at all of those things in sum, those sort of seemingly little things, it's quite profound.
Mm-hmm. Well, just off the top of my head, just beyond the retail side or an institutional side, people are also talking about central banks, tokenizing some of their currency. You think there's any chance we'll see that, like in 5 years, that you'd be able to access, tokenized dollars from the Fed, for example?
I'm not sure who will be the first mover. I am certain it's going to happen. Just looking at if you look at all the projects that are going on at various central banks, whether that's the European Central Bank, whether that's, the Central Bank of UK, Singapore, there's some very, very interesting projects going on, and I think it's inevitable. I think it creates enormous efficiencies and obviously a degree of settlement finality that currently doesn't exist in the financial system with commercial bank money. So these are things that I think are absolutely going to happen. I think we'll see some pioneering central bank do this within the next 5 years. I don't know if it's going to be the Fed, but somebody will do it.
Yeah, well, definitely somewhere in Asia. That's from what I see, that's the most innovative right now with accepting blockchain technology. Okay, so for our audience that can make it next week to London, to the London Summit, what else do you think they need to know about blockchain technology and FX?
Yeah, I think one of the other things that we're really excited about is using our same technology stack that we're doing this in the FX space. We can solve some of the biggest problems in the cryptocurrency space as well, including making it possible to aggregate and trade on liquidity across all of the exchanges. We can basically do cross-exchange clearing and settlement. And I think that given our background on the FX side and our knowledge of how to deliver FX prices down to retail trader desktops, I think that there's a big play here for getting cryptocurrencies down to the retail FX speculator level. And there's probably a huge push that we'll see coming in the coming year, in working with retail brokers that have an interest in bringing that kind of product to the clients, whether that's the actual spot, the cash cryptos, or whether that's some of the products that we're now starting to interact with. We're working with a few folks looking at clearing and settling their Bitcoin NDFs and other kinds of derivatives. So there's a lot of interesting things coming down the path, I think, on the crypto side, which will make be a whole new exciting business, I think, for the retail FX shops.
Definitely, yeah. Everybody's buzzing right now about cryptocurrencies, and they're all looking for where can they get liquidity, where can they get data feeds, and so definitely there's a place for more trustworthy platforms and providers. So I want to thank you again, Rosario, for taking the time. And everybody, there's going to be a link beneath this, beneath this video or audio, whichever way you're following us, with the link to how to register for the panel. And we hope to see you there. Thank you so much, Rosario.
Thank you, Avi. My pleasure. Look forward to seeing you next week.
Me too. Bye-bye.
Bye.